Frequently asked questions. Seller financing and 1031 exchanges. It's not uncommon at asset preservation to get the question from an investor, how do I handle a situation when I am selling an investment property and some of the consideration is going to be a note that I'm carrying back, what is referred to sometimes as seller financing or a transaction involving the installment sale rules under Section 453 of the Code. In this situation, where a taxpayer sells a property held for investment and they receive some money, some cash at the sale, but also part of the consideration is a note that they will be carrying back, essentially helping to finance the sale for the purchaser. How can that be handled in a 1031 exchange? And in this segment, we want to look at the options when a taxpayer is selling a property with seller financing. And let me go through this on the slide, and you'll see the ways that this could be treated. And it's kind of a lengthy discussion, but I want to go through the options. First option, the taxpayer could not include the note in the 1031 exchange. And what this means is the taxpayer can do a 1031 exchange on the amount of money that the purchaser comes in with cash. That portion, they can use a qualified intermediary, purchase a replacement property with whatever that down payment is or that equity is involved. And in this scenario, if the taxpayer keeps the note, essentially they are the beneficiary on that note, they will then receive the installment sale treatment on that note under Section 453. And essentially what Section 453 says is this: a taxpayer pays taxes as they receive the payments. So it's not uncommon for those to be split over a period of time, typically 3, 4, 5, 6, 7 years. And maybe sometimes they're structured where there's a balloon payment at the very end where the principal is paid off. In that scenario, the taxpayer receives the installment sale treatment and just pays taxes as they receive those note payments over that period of time. The other option, which you'll see as option B, is to include the note in the 1031 exchange. And when I say include the note in the 1031 exchange, what that means is the note is assigned over to the qualified intermediary, and the qualified intermediary is the beneficiary on that note. So it's option A, taxpayer can do an exchange. They are the beneficiary on the note. They receive the installment sale treatment over time. Option B, the qualified intermediary is the beneficiary on the note. And so once we have that established, there are 4 different options that are available to the taxpayer. And let me briefly address those. Number 1 is to use the note towards the purchase of a replacement property. And the way that this would be accomplished is the cash proceeds that come to the qualified intermediary, those are applied to the purchase of a replacement property. And under this method, item number 1, the note would then be assigned to the seller of the replacement property as additional consideration. So it's using simplistic numbers to try and illustrate this point. If a taxpayer receives $30,000 in proceeds and has a note for $70,000, and they purchase a replacement property worth $100,000, the $30,000 in proceeds are transferred from the qualified intermediary to the seller of the replacement property, and the note for $70,000 is assigned to the seller of the replacement property. Under this scenario, the taxpayer that is doing an exchange would obtain full tax deferral because they've assigned the note over. Now, practical considerations with this way of proceeding. One is, it is a viable alternative, and we do see people take advantage of this. It tends to work best when you're working in a market where the seller of the replacement property is located near where the relinquished property is sold. So if somebody knows the marketplace and they understand the security, how much the property is worth, those types of things, this might become more realistic. It becomes a little less feasible when you've got a scenario where that seller of the replacement property has no idea about values of where the relinquished property was sold and isn't comfortable with it. So this is a strategy, but it's probably limited, in our experience, is limited to scenarios where that seller of the replacement property is very comfortable with the value of the relinquished property. second option, under option number B, including the note in the 1031 exchange. If the note is paid off within 180 calendar days, these proceeds are applied to the purchase. So using the same scenario, a $30,000 down payment, and let's say it's a short-term note. Let's say it's a 4-month note. The intermediary is the beneficiary in the note. The note is paid off, so all the proceeds go to the qualified intermediary, the $70,000. The qualified intermediary then purchases a replacement property for $100,000 with the $30,000 proceeds that they initially received, plus the $70,000 note payoff. So that's full tax deferral. And that would apply in a situation where the installment note is essentially for 179 days or less. So a very short-term installment note. Third option, under including the note in the 1031 exchange. This would be a scenario where the taxpayer purchases their own note out of the exchange. And sometimes it might be the taxpayer, or it could be even a family member, somebody along those lines, that has the cash resources that wants the income stream from that note purchase. So here's what that looks like. The qualified intermediary sits on $30,000 of exchange proceeds. The qualified intermediary is the beneficiary on the note. The taxpayer comes in with $70,000 of additional cash, so outside cash. They purchase the note from the qualified intermediary. So the intermediary receives the $70,000 cash. The note has been purchased. The note then is assigned back to the taxpayer, and they go ahead and receive the payments on the note. In that scenario, the taxpayer can obtain full tax deferral. So they would purchase a $100,000 replacement property with the $30,000 of exchange proceeds and with the $70,000 of the proceeds from the purchase of the note. The fourth scenario and last one, if you try scenario number one and a seller of a replacement property doesn't want to take a note as consideration, option number two is not available because the note is not a note that will be paid off within the 180-day exchange period. And option number three is not a viable alternative because the taxpayer doesn't have the cash or doesn't know somebody close by who has that amount of cash to purchase the note. There's one final alternative, which is selling that note on the market. And so that's typically sold to people that buy notes. Well, one of the things to keep in mind in that scenario is that somebody who's going to buy a note that's brand new, it's not what's considered a seasoned note. There's very little payment history on it. So in that case, somebody who's going to buy a note in the marketplace is typically going to discount that note fairly significantly. And that's really up to the purchaser of the note to determine how much. But we've seen typically it's not uncommon to have a discount rate of maybe 25% to 35 or 40%. So that $70,000 note, the taxpayer is not going to receive the full $70,000 if they sell the note to just a note buyer. Let's say they receive $50,000 for that note. So in that scenario, a replacement property could be purchased for $80,000. So the $30,000 that was originally applied in the purchase, plus the $50,000 for selling the note to a note buyer. And by the way that happens mechanically, the qualified intermediary is the beneficiary of the note. They would go ahead and receive the $50,000 in proceeds, and the qualified intermediary assigns that note to that outside note buyer. Then they would buy a property for $80,000. Essentially, that discount of the $20,000 in this simple scenario is treated as an effective reduction in the sales price of the relinquished property. So those are the four options that are available when you include the note in the 1031 exchange. Now let me go ahead and kind of close out this discussion because there's one important piece. If a taxpayer has the qualified intermediary as the beneficiary in the note, and under option B, including the note in the 1031 exchange, essentially having the qualified intermediary as the beneficiary, if option 1 doesn't work out, 2, 3, or 4 don't work out, then the intermediary can assign the note back to the taxpayer, so they become the beneficiary, and in that scenario, they're right back up into position number A. The taxpayer receives the installment sale treatment on that note. So at the end of the day, If none of the four options under option B, including the note and the exchange, by having the qualified intermediary as the beneficiary, work out. If none of those work out, the very worst case scenario is the taxpayer goes back to where they would be at position number A. They defer taxes on the down payment, and then they receive the installment sale treatment on that note. This has just been a fairly brief overview, and realize there are other considerations to take into account. To review your specific 1031 exchange situation, contact Asset Preservation's headquarters in California at 800-282-1031 or our Eastern Regional Office in New York at 866-394-1031. Please read the full disclaimer, as Asset Preservation cannot provide tax or legal advice.